Hi, Gabriel Josiah here. In this session, we are tackling the total asset turnover ratio, a crucial metric for assessing how well a company utilizes its asset to generate revenue. Whether you are preparing for exams or looking to boost your analytical skills, understanding this ratio will help you gauge operational efficiency and asset management. Let's break down this ratio and how it works and why it matters for both your studies and real-world financial analysis. Let's dive into it as I share my screen and we discuss and also practically explain with example what the total assets turnover ratio is all about. Total asset turnover ratio measures the efficiency and effectiveness with which an entity's assets are used to generate sales revenue. So we have a set of assets employed or deployed for the business in form of non-current assets, which are our traditional fixed assets. And we also have current assets for the day-to-day running of the business. So a combination of those two asset classes is what is merged into or added to have the total assets. So our total assets are used to generate revenue for the company. So the higher this ratio, the more effective the company is in the use of resources invested in its assets to generate revenue. So the total assets turnover ratio, how many times does the revenue cover this asset, shows us that there's efficiency in utilization of these assets to attract or generate returns in form of revenue or sales. These ratios can be used to measure the effectiveness of a company in the use of all its assets for each component of the assets. The above ratio, or the total asset turnover ratio, is calculated this way. Our sales or revenue is the numerator divided by our total assets, which has to do with your non-current assets and your current assets. It measures the rate at which total assets generate sales revenue, like we've discussed previously. The ratio measures how efficiently the company uses its asset to generate revenue. It also reflects the ability of a company to convert its asset into sales, and is a key indicator of operational efficiency. This is very important. So management is efficient when returns are generated after assets have been employed into the business. So a higher ratio signifies better asset utilization, and the lower one indicates inefficiency in using available resources, or you could say underutilization of the assets. Okay, so this is the formula we'll be using. We have the net revenue, or your sales, divided by the average total assets, where the net revenue includes net sales includes total revenue generated from sales, while the average total assets include the beginning total assets at the start of the year, 1st January 2020, plus the ending total assets, 31st December 2020, or whichever year it is, divided by 2 to have the average. So looking back at the formula, we have it as net revenue divided by average total assets. So this is the description. Now let's go back to the example we've been using to practically buttress and explain this formula and how to calculate it. So we've been using Sharubutu, as you can see my screen, Nigerian PLC, to explain all our ratios, and this example has been all-encompassing and helps us to cover and understand practically how to calculate these ratios and its practical application and implication on a business. So let's start with our net revenue, which is the numerator. So our revenue for the year 31st December 2020 is 1.2 billion. So I'll click that. If you have your calculator, just follow me closely as I demonstrate how to calculate this ratio. So we have our sales revenue of 1.2 billion naira. So from the formula, we have it as average total assets, where our total assets is the beginning assets and the ending total assets. So let's go back to our question and pick that graphically. So while our sales revenue is in the statement of comprehensive income, our total assets is definitely in the statement of financial position. So we have the non-current assets and we have the current assets, as you can see on the screen. So a combination of both is what culminates in our total assets. So we have the beginning, like you could see on the screen, 1st January 2020, and we also have the ending, 31st December 2020. So we take the total assets, both beginning and ending, to get the average. So I'll take this, bring it to my calculator. It's very easy. So I have total assets at the beginning. So let me drag that. I also have the total asset start, end. So our beginning total asset or the figure is 1,250,000 naira, while our ending total asset is 1,595,000 naira. Okay, so let's get a total of that. We have it as 2,845,000,000 naira. So let's have the average total assets, which is our total assets, the beginning and the ending, divided by 2 to get the average, which we have it as, beg your pardon, which we have it as 422,500,000 naira, as you can see on the screen. So right now, we want to calculate our total assets turnover ratio. So total asset turnover ratio is simply our sales revenue divided by our average total assets. Average total asset. Very simple to calculate. We have it as 1. And we have it as 1. So our sales revenue divided by our average total asset, we have it as 1. So 1 means the total asset covers, or I beg your pardon, the sales revenue covers the total asset once. It covers the total asset once. So above 1, 2, 3 is better, but then it shows that revenue has been generated above the assets that was employed in the business one time. One time. So I can practically type it as 1 time. So let's see what this means. What does this mean? Let's go back to our explanation. It means the total asset turnover revenue, ratio shows how much revenue is generated for each dollar or naira of assets a company holds. The higher ratio indicates that the company is making good use of its assets to generate sales. So we have it as 1 time. If you have it as 2 times, shows your revenue has doubled your asset employed in the business. Whereas a lower ratio might suggest that the company is underutilizing its asset. So for the start of 2020, it's okay to have one time at least revenue on the assets employed. So what's the implication? A higher total asset turnover ratio suggests that the company is using its assets effectively and efficiently to generate revenue, which can be a sign of operational effectiveness. This is very important. Conversely, a lower ratio may imply inefficiency, indicating that the company is holding excess assets and not utilizing them effectively to drive sales. So for example, in our example, if we have less than 1, let's say 0.5, it shows that the company has only generated revenue to the tune of 50% of the asset on the ground. This is very critical. Now, what is the cause and effect? So a high total asset turnover shows or is caused by efficient use of resources. So if you have 1, 2, 3, 4, 5 times, that means your revenue is above your total asset like 5 or 6 times, then it shows the company is really doing well, is efficiently using resources, optimizing operations, generating high sales volume relative to its asset base. Now the effects are better profitability when you have a high total asset turnover ratio, improved asset utilization, and a stronger operational performance. While conversely, a lower total asset turnover is caused by underutilization of asset, declining or low sales turnout, inefficient asset management, and holding excess inventory without marketing or pushing it out to convert to cash or sales. The effects of a low total asset turnover ratio is lower profitability, potential cash flow issues, and increased carrying costs for unused assets. This is critical. So in conclusion, the total asset turnover ratio is a key measure of how efficiently a company uses its assets to generate sales. The higher the ratio, the better, and it reflects good asset utilization and operational efficiency, while a lower ratio indicates areas for improvement in managing assets and driving revenue. So companies should aim to strike a balance between asset levels and sales generation to enhance overall profitability. So as chartered accountants in practice, in training, this is our job to ensure that we efficiently monitor this ratio and help the company strike a balance between asset levels and sales generation, culminating enhancing overall profitability. This is very important. So having looked at this powerful ratio, in summary, the total asset turnover ratio is, like I said, a powerful indicator of a company's ability to generate sales from its asset base. A high ratio signals strong asset utilization, while a low ratio highlights areas for potential improvement. Thank you for tuning in. Be sure to like, subscribe, and share the video for more insights on financial ratios and its practical application. Remember, mastering asset efficiency is key to driving profitability. See you in the next video and the next class. Until then, bye for now.